So, you're looking for a way to protect and grow your retirement savings, but without all the stress and volatility of the stock market? Well, today, we're going to pull back the curtain on a really powerful tool that might just be the answer: the fixed annuity. Let's break down exactly what it is and how it works.
I mean, this is the big question, isn't it? Especially if you're getting close to retirement or you're already there. You've worked so hard for your savings, and you want them to keep working for you, but safely. So where do you turn when the market just feels, way too risky? And this really gets to the heart of the matter for so many savers. You've got the market over here, where your principal, your hard-earned money, could go up, sure, but it could also go down. And on the other side, you have the promise of guaranteed growth. Your principal is protected, and your returns are locked in. It really is a choice between unpredictability and, well, peace of mind.
So this dilemma kicks off our first section: the search for that perfect combination of meaningful growth and real tangible security.
This is the frustration for so many people. You look at your bank savings account or your CD, and the interest rates are just kind of sad. Your money's safe, yeah, but it's barely growing, if at all. Then you look over at the market, and sure, the potential returns look great, but so does the risk of losing a chunk of what you've saved. It can totally feel like you're stuck between a rock and a hard place.
But what if you don't have to choose between too low and too risky? This is where a third option enters the picture. So, let's meet the fixed annuity.
Now, to be specific, we're talking about a type of fixed annuity called a multi-year guaranteed annuity, or MYGA for short. Honestly, the absolute simplest way to think about it is right there on the screen. It's like a certificate of deposit, a CD, but you get it from an insurance company instead of a bank. It's built for one thing and one thing only: predictable, guaranteed growth over a set number of years.
So, how does a MYGA really stack up against that bank CD we all know? Well, a few key differences really jump out. First, obviously, the issuer is an insurance company, not a bank. Second, the rate on a MYGA is almost always higher. But here's the kicker: a huge advantage: the taxes. With a CD, you have to pay taxes on the interest you earn every single year. A MYGA, on the other hand, lets your money grow tax-deferred. That means your interest earns interest without getting a haircut from taxes each year, which really lets it compound and grow faster.
And here's what that rate advantage looks like in the real world. Check this out. These are actual MYGA rates from our source as of October 2025. You can see terms offering over 6%, guaranteed. For anyone used to the rates on traditional bank products, numbers like these are definitely going to grab your attention. It just shows how competitive these can be.
Okay. High guaranteed rates sound awesome, but this is where any smart saver starts asking the important questions. So let's pull back the curtain on the fine print and make sure we understand all the rules of the road.
Exactly. What's the catch? That's the question everyone asks, right? Anytime you see a guarantee, you should always understand the conditions. It's not really a catch, but there are definitely rules you need to know.
So the main rule is something called the surrender period. It's basically the contract term, the number of years your interest rate is guaranteed. If you decide you need to pull out more than the allowed amount of money during this time, you'll face a surrender charge. It's just the insurance company's way of making sure they can keep your money invested to actually pay for that great guaranteed rate they promised you.
You might also hear a term called a market value adjustment, or MVA. Now, this sounds super complex, but the idea is actually pretty simple. It only applies if you take out more than the allowed amount before your term is up. The adjustment just reflects whether interest rates in the wider world have gone up or down since you started. But here's the absolute most important part to remember. If you just hold the contract until the end, the MVA has zero effect on your money. None. It doesn't apply.
And this lets us bust a really common myth. Your money isn't totally locked away in a vault. Not at all. Most of these contracts have liquidity features built right in. You can usually take out up to 10% every single year, penalty-free. They're also designed to be friendly for required minimum distributions from your IRA. And in really serious situations, like a major health event, those penalties are often waived completely. And of course, when the term is up, it's your money. You get 100% access to all of it.
All right, now for the million-dollar question, the one that's probably on everyone's mind. How safe is my money really? Let's put the safety of a fixed annuity head-to-head with some other familiar options.
It's a totally fair question. We all grew up hearing about FDIC insurance at banks, so how does the protection for an annuity really stack up? Well, the data might actually surprise you.
This chart tells a really powerful story. Using data from the FDIC and the Insurance Guarantee Associations, it shows institutional failures over a 25-year span. Look at that bar on the left, bank failures, 570 of them. Now look at the bar on the right for annuity company liquidations, just 11, in the same amount of time. That's a staggering difference, and it's because insurance companies are required by law to be incredibly conservative with their money.
And that's why our source can confidently say that fixed annuities are considered one of the absolute safest places for your retirement savings. It's not just a sales pitch. It's backed by a decades-long track record of incredible stability.
So what about another classic safe haven, U.S. Treasuries? Well, here again, for retirement savers, MYGAs often come out on top. They typically offer higher yields, and you get that powerful tax-deferred growth we talked about. Plus, your principal is 100% protected, whereas a Treasury bond could actually lose value if interest rates go up and you need to sell it before it matures.
Okay, so you get what a fixed annuity is, you get how it works, and you see how safe it is. If you're starting to think this might be a good fit, let's wrap things up with a quick guide to being a smart shopper.
First things first, context is everything. According to our source material, as of late 2025, interest rates are really high, which is great news, but they're expected to start coming down. So what does that mean for you? It suggests that locking in one of these high rates right now for a longer term, like 5 or 7 years, could be a really strategic move.
So if you're going to explore this, here are 4 simple rules to be a smart shopper. 1. Stick with the big, financially strong insurance companies. Look for an A- rating or better. 2. Pick a term length that actually makes sense for your goals. Don't lock money away for 10 years if you think you'll need it in 5. 3. Always compare rates. And finally, 4. Just make sure you're crystal clear on those liquidity features before you sign anything. Following these steps will help make sure you find the perfect product for your needs.
And that really brings us to the final question, which is one only you can answer. In a world with so much financial uncertainty, what is the value of a guarantee? Is that predictability, knowing exactly what your interest rate will be, and knowing your principal is completely safe? Is that the right choice for your financial peace of mind?